Okay. All right. Today we will do like investment portfolio theory. After we finish this basic calculation, we'll cover like Markowitz portfolio theory part 1, and then part 2, and then finally capital market theory. So the first part, basic computation or calculation, is we already did this one in chapter 1 and 2. So let's do some review. So when the probability distribution of stock returns are given, we are interested in getting an expected return and standard deviation as a measure of kind of average return or expected return and the risk level. So as you see, the expected return is the weighted average of each possible return. So P times R, let's do that, P times R, this one. And then if you calculate this one and then sum them up, and sum them up, okay, C8, yeah. So we get the 10.3%. 10.3%, is that right? 10.3% is our expected return there. And then standard deviation, I think you know that, the formula. So that is RI minus 10.3, so 0.103, okay, 0.103, let's put it there, and then copy and paste, right? Okay, now you have to like get the squared deviation times the probability. So probability times this one to the second. So basically, this standard deviation is the sum of squared deviation and weighted sum of square deviation of return. I mean, in words, that should be the definition. So let's calculate each individual weighted return. So the first one times square deviation, right? So we calculated all this square deviation. Now, if you sum them up, that will be your that is the variance, right? Variance. So this should be square root. I mean, this one is variance. So standard deviation is this one to the 0.5. So 2%, right? So 2.12%. That is your standard deviation of this one. This is how you calculate, the expected return and standard deviation. Just review of what we did in chapter 1. In Excel is very useful. You can do it, whatever you want. Yeah. Now we have this as that one is the expected return and standard deviation for asset 1. Now the next one, asset 1 is here. I mean, asset 1 is here. But suppose our portfolio, our investment portfolio includes 4 risky assets. So asset 1, asset 2, 3, 4. So we have what? We have weights. This is 20% of asset 1, 30% of asset 2, 30% of asset 3, and 20% of asset 4. This just simply, and with return, if we calculate weighted return. So weight times return. So if you calculate all of them and then sum them up, this is simply weighted average of this return. Okay, 12%. So our expected return of our portfolio of 4 stock, 4 risky asset is 12% there. That's how we calculate the portfolio expected return. We did that too, right? This one, the last review, let's do this one here. We are given this monthly return of Standard & Poor's 500 stock, and then monthly return of treasury bonds. As you know, Standard & Poor's 500 is widely used as the market index, right? Market portfolio. We'll do that later on. Okay. Now we simply have stock portfolio and bond portfolio here, right? For like 12 months. So let's calculate the mean return. So in this example, you are given historical data of stock returns, right? Historical data. If you're given historical data of stock return and the kind of average is just simple average is this average of all this 12 monthly return. It is the average return. So average return of Standard & Poor's is 0.98%, and let's wait. This bond portfolio, T-bonds, treasury bonds. Average return of the treasury bond is 0.22%. You know, if you look at the size of these two assets, two portfolio, S&P 500 is like 0.98 monthly return, and T-bond is 0.22%. Now, it's a significant difference, right? About 4 times, or 4 point sometimes, right? 4.5 times. As you know, right, you remember that the risk-return trade-off, the higher the risk, higher the return. Lower the risk, lower the return. That's exactly like, indicate that the difference in the risk between one is stock in a portfolio, one is treasury bond, government bond portfolio. So you see that the stock S&P 500 return is much higher. That means this stock or portfolio is much higher risk, much high risk. Okay, so let's calculate the standard deviation, the risk measure, and see whether it support that risk return trade-off or not. Standard deviation for S&P 500, so is equal standard deviation, right? And actually, if you have small sample, you could like put sample standard deviation, right? And you highlight this 10 and 12. That's a sample standard deviation, right? Sample standard deviation. You get 2.96%. So let's decrease it. 2.97% standard deviation. On the other hand, the treasury bond has 1.07%. Do you see clear pattern of risk return trade-off there? Of course. So this one was like average return for this S&P 500 and average return for treasury bills, and then the risk measure there. Now covariance. Covariance is that measures the co-moving pattern of these two portfolio, right? These two portfolio. So let's calculate this way. I mean, you do this way, yeah. Now, covariance is just covariance right? And then highlight this one column, and then highlight the other column, right? All right, what do you see? We have negative 0.62%, negative 0.62. Now, I told you covariance that measures the co-moving pattern of these two portfolio, right? We have two measures for that. Two measures of the co-moving pattern between two portfolio or two stocks or two portfolios. One is covariance, the other one is correlation. The difference between these two is covariance that shows, shows the positive or negative sign. Positive sign, that means these two stock, the portfolio tend to move in the same direction. That's positive, the sign. If it is negative, these two stocks or these two, the asset portfolio tend to move in the opposite direction. Okay? So for covariance, only the sign matters. We have negative sign there. That indicate these two portfolio tend to move in the opposite direction. So if you have negative the correlation or covariance, if these two tend to move in the opposite direction, that's a good candidate for the investment diversification. Okay, so you want to include like stocks with negative like covariance or correlation. Okay, now comparing this covariance with the correlation. Covariance, it shows the direction of these two movements. However, the size of this one, 0.62, that does not tell you that much. That does not tell you like any meaningful like story. So the covariance, in covariance, only the sign matters, but it does not, the size of this one does not like show like strength or anything else. Correlation coefficient does it. So let's calculate correlation coefficient. So correlation, comma, and this is T-bills. You do that. This is the Excel command. Now look at this one here. It gives you minus 0.21, right? Minus 0.21. If you go back to the one discussion, correlation coefficient, that is more useful because first let me this one. This correlation coefficient, Rij or rho Ij. If some textbook they use R, some textbook they use rho here. But those are same thing. Rij, rho Ij. Now, the R correlation coefficient is important property of R is between -1 to -1. Oops. R 1. So the size of this one, all right. Okay, the size of this correlation coefficient is between -1 and 1. Yeah. Now, I told you covariance, in covariance, only the sign matters, but this one, correlation coefficient, is not only the sign, but also the size of this, the R coefficient, correlation coefficient. So because here, if R is positive, If R is positive, that's called positive correlation. Positive correlation. That means, these two stock or these two portfolio tend to move in the same direction. And also, if R approaches 1, that correlation, that co-moving pattern is very strong. Okay? If R is lower and lower approaches 0, I mean, very low, R is like between, for example, 0.1, then this two has very weak positive correlation, meaning these two stocks are weakly, like positively moving together, right? Moving together. If R is equal to 0, if it is like close to 0, that is what? The 0 correlation. That means there's no meaningful relationship between these two. So this moving pattern are not associated or related. No meaningful relation between these two. Okay? If R is negative, is a negative correlation. Negative correlation. That means these two tend to move, in the opposite direction there. As you see, that is the S&P stock portfolio, and the T-bills, they shows minus 0.21, right? Minus 0.21. That means first, this is negative correlation. They tend to move in the opposite direction, but it's not very strong. 0.21. If it is 7 or 8, 9, then that's we can say that a very strong negative correlation. But this one is a weak negative correlation there, right? If it is if R is 1, R is 1, that's called perfect positive correlation. If R is -1, is the perfect negative correlation there. See? So our S&P 500 and the T-bonds that shows minus 0.21 is a relatively weak correlation coefficient, negative correlation. Now, if you have negative correlation, these two are good candidate for your investment risk diversification, right? Risk diversification. So you want to include these two stocks, these two assets in your portfolio, right? So for risk diversification. Okay, now let's move on to the Markowitz theory, Markowitz portfolio theory. Do you have any question before we go on? Just let me know. Okay. Markowitz portfolio theory, part 1. The first part of Markowitz portfolio theory gives this model, this mathematical quantitative model for return and risk of a portfolio. That one is like first groundbreaking, like contribution by Harry Markowitz, right? So the first one is the return and risk of a two-stock portfolio. So the first one is what is the portfolio or return? Is just simply weighted average of individual return. So W1, W2, that's the investment weights, right? And then R1, R2, that's the individual return. Okay, so weighted average of individual return. And then beta, this is beta, there's risk measure, right? Risk measure. What is the portfolio's beta? It's also this weighted average of individual beta. That's fine, okay? Okay, up to this point, that's good. Then what is the risk of this the portfolio? Now, based on these two discussions here, you may be tempted that the portfolio risk is the weighted average of individual risk. So W1 times sigma 1 plus W2 times sigma 2. You may be tempted to say that, but it is not, right? The Harry Markowitz, he provided this clear, straight risk measure equation there. It is not weighted average, but you should go through this one, right? W1 squared, sigma 1 squared plus W2 squared, sigma 2 squared, plus 2 W1, W2, sigma 1, sigma 2 times R12. R12 is the correlation coefficient, right? So when you measure this, the risk and the standard deviation is the square root of this variance. So this is variance. So when you look at the equation, the reason why the correlation coefficient is important in risk diversification or risk hedging is if this part, R12, if R12 is negative, then that will decrease, the whole thing will be negative. That will decrease this entire variance or entire risk measure, quite a bit. So negative correlation or negatively correlated stocks are good candidate for risk measure. This is the reason. Okay? If it is this one is negative correlation, that will decrease the entire total risk measure, significantly or to some degree. Okay, so that's the two-stock portfolio. We have to use this formula later on. Now, three-stock portfolio is a little bit more complicated. So if you want to include like stock portfolio and stock index or bond index, and you want to include like real estate assets. So we have three different like the individual investment instrument. Now, if you combine those three, then this is the formula that you have to use. Okay. So the return of a three-stock portfolio, return of this three-stock portfolio is the weighted average of individual return, and beta is weighted average of individual beta. Okay, and then the standard deviation variance is you have to follow this. Okay, that's quite long, not so friendly, right? The equation there, and standard deviation is square root of this variation. Now, if you generalize to end stock portfolio, the same thing. This one is more complicated. Okay. That is the first part of the Harry Markowitz portfolio theory, and his groundbreaking contribution to modern investment theory. All right, let's apply this model to actual number. Suppose we include two stock portfolio. We construct two stock portfolio. Right? One is stock 1 and stock 2. Now why stock 2? Okay. So the stock 1 has expected return of 10% and standard deviation of 7%. Stock 2, 20% and 10%. So you include those two. Let's do this experiment. Okay. Then now suppose if these two stocks have correlation coefficient of -1 and then 0 and +1. So all right, let's do this one here. Now the weights, stock 1 weights in the first case is you invest 100% of your capital in stock 2. The second case, 40% in stock 1 and 60% in stock 2. Now the third case, 50%, right? And then fourth case is 60% on stock 1, 60% in stock 1, and 40% on stock 2, right? And then the last case, 100% of your investment capital on stock 1. All right, let's analyze this one. since we have the Excel, we can do the whole thing, very quickly and easily. All right. Standard deviation. Let's calculate standard deviation. We have to follow this formula, right? Here, to start portfolio, we have to follow this formula. So how do you do that? Let's see. W1 squared. I mean, it says, since we don't see that at the same time, I'll just continue this way. Here, W1 squared. So this one, W1 squared times the standard deviation of step 1 squared plus W2 squared times this step 2 standard deviation squared plus 2 times W1 times W2 times sigma 1 times sigma 2 standard deviation times what? Correlation coefficient. So this is exactly the formula of Markov portfolio theory there. Now, I think you know how to use the Excel. Now, this one, we want to fix these 3 measures. So what you do is this one, put $sign and $sign, and then also the $sign and $sign, and then later on this one also $sign and $sign, this one $sign, $sign, this one $sign, $sign. You know what I did, right? Put the $sign inside there. Then you want to fix that cell in wherever you go. So see there. Now get this. If you invest 100% of your capital on stock 2, then that means this one here, right? This one. So your risk measure standard deviation is 10%. Oh, that's variance. All right, just a moment. We just did variance, so we have to square root of it. Square it. All right, square root. You following me? We have 10%, right? We have 10%. Okay. Now, expected return is nothing but weighted average, W1 times R1 plus W2 times R2, oops, yeah, this one, R2, this one. But we want to fix this, R1, R2. So we put this one here, this one, and this one. All right, that's 20%, right? 20%. Okay, we did this one here. Now let's copy and paste. And we did that. Right? The only reason I put the $sign to fix the value, the cell, is to copy and paste. Copy and paste. All right. That's what I did. So what we did was we just applied the Markov portfolio theory, the theory model to this case, including the correlation coefficient. Let's do the same thing. I mean, I think we can directly copy there, except we have to change, everything is the same thing. We have to change this correlation coefficient there. B27, now this time is G27. G27, all right, G27. Okay, so when the correlation coefficient is 0, then we applied everything here. This W1, I mean here is W1, so F30, W1 squared sigma 1 squared. Sigma 1 squared is a C25 and W2 squared and sigma 2 squared at time and standard deviation D25. That's correct. Okay, so we did this one here. Okay, and this one same thing. Okay, so if we copy and paste, all right, that is the value. And the last one is the same thing. All right, there. So correlation coefficient. When the correlation coefficient is 1.0, and that is what? That's L27. So L27 is there, right? L27. So yeah, I literally applied to the Markowitz, the mathematical model, to calculate standard deviation and the expected return to with the different correlation coefficients there. So let's copy and paste. Right. Now, did you follow what I did here? Anybody who didn't follow or has question about the process that we just did? Let me know. So you know how to do this one, right? It's simple. I mean, the only thing that I did was to fix each cells, right? C25 is this one here. Fix this cell on Excel, right? On Excel, and fix this correlation coefficient, right? And then you can apply that. If you do that, you can just copy and paste. I think you did that somewhere, right? Okay, the next one. Now I'm going to show all these numbers calculated. This is portfolio risk, portfolio return for the case with the correlation coefficient -1. That's perfect negative correlation. This one is the case for the 0 correlation coefficient. This one is the case of the perfect positive correlation, right? Oh, wait a second. Let me get rid of this. Get rid of this. Oops. Wait, what did I do? Okay. No. Oh, wait. Okay, now, let me show you. I think you know how to do calculation, right? How to calculate. What I'm going to do is to show this portfolio's risk and portfolio expected return graphically. So I just highlight this 2 column and then insert graph. Where is graph? Graph. And then you go more the scalar chart and XY. You have to pick XY and then this one. Okay, and then you have to pick this one here. You see that? Now, this like X column, the X axis that shows the standard deviation. Y axis is expected return. So in investment analysis, that is the pattern. Always you show risk on the x-axis, and the return on y-axis. All right. Now we want to include this one too. Let's see. Select data and add more. Now x value is this one, and y value should be this one here, right? If you like highlight this 2 second case and then put it there, all right? then you see this new graph, additional graph. And also, let's add one more because we have one more. Oops. Here. This is X variable, and this is Y variable. Then, okay. Now look at this. We got this nice looking, graph there. The blue is the case when correlation, the perfect negative correlation, and this orange, that is the zero correlation coefficient, and this straight line, that is a perfect positive correlation. All right, let me explain what this means. Okay. Now look at this one. Look at the 15% return. Let me just go straight to the point. Now, to create 50%, there's three different cases, right? There are three different portfolio that provide their 15%. 15%. Now, the first case, the risk measure for the first portfolio, it is 15%. Is 1.5% there. Do you see that? To create 15% return, the risk measure is 1.5%, right? So this one is 1.5%. This one. Now, second case, when correlation coefficient is 0, that increases to 6.1%. You see that, 6.1%. Now, the third case, when correlation coefficient is like 1, positive correlation, for the return, the risk measure is 8.5% there, 8.5%. What do you see there? We have these three different portfolios. For the same return, the first one has only 1.5% risk. The second one has 6.1% the risk. The third one is 8.5%. Which one would you choose? Which one would be most beneficial for you? Definitely the first case. For the same risk level, you prefer lower risk, right? Lower risk to higher risk. So in this case,
I think I know what happened to all your.
Say it again. Say it again. All right. Okay. So for the same return level, one has 1.5% risk, the other one is 6.1%, the third one is 8.5%. So, I mean, this one gives you much better when correlation coefficient is lower, negative, that gives you the benefit of risk diversification. This is called risk diversification. It's a graphical illustration of risk diversification in your investment. Okay. So that's where I wanted to, reach. Okay. That is the second one. So, I mean, this one, if you compare first one and second one, the whole area could be like, the size of risk diversification. Okay. All right, Markowitz portfolio theory. So the first one is largely the mathematical quantitative model. I mean, the first important significant contribution by the Markowitz theory is to quantify. He successfully quantified mathematically the size of risk and return of a portfolio. That's the one important, contribution. Second one is, is the descriptive, right? So we saw when you combine two different stocks like this, two different stocks, the general pattern is, as you see, it's like this shaped curve, right? This shaped curve. So we start with this one, this shaped curve. That's a quite, typical general model, right? General model. If you put two stocks, all this one is possible, like combination of the possible combination of these two stocks, right? And then if you have three stocks, is different pattern there, different pattern. So any point on these lines will be potential investment in investment opportunities. If you have multiple stocks, many stocks, in this case, 13 stocks, any point on this this combination is possible investment. Actually, there should be this way too. I mean, it should be this kind of combination should be for every pair. Every pair. If you have numerous stocks in your portfolio, like 100, 200 stocks, then it's kind of umbrella style like group. Everything inside this umbrella should be the investment possibility. Okay, but they are not equal. Okay, a simple idea like dominance is this. Simple idea is, now here, let's look at this one here. BC line, the vertical line there, vertical line. Everything, this one is the investment possibility sets there, right? But they are not equal. Look at this. Let's get straight line. Straight line, that is the standard deviation of this one here, right? The all possible investment options with the standard deviation of this. Now, one of the, let me write down here. Yeah, for the same, for a risk level, highest or higher return dominate lower return. Right? This is very common sense. It's a common sense idea. For a certain risk level, higher return dominate lower return. Of course. So look at this here. All possible combination here. B dominate everything below there. All right? The same thing here. This point dominate everything below that. And same thing. And let's look at another perspective. For a return level, lower risk dominate higher risk. Very common sense, right? For return level, that means AC. Let's draw AC line there. So AC, everything on AC is investment possibility, right? So for the same return level, low risk dominate higher risk. That means A dominate everything to the right. Okay. So if you apply these two ideas of dominance, then every possible investment combination below this line, this boundary, below this one is completely dominated. So that means, here, look at this. The all possible like investment combination on this curve, dominate everything below that curve. So this combination on this curve AB, that is the group of most dominant investment decisions, investment combination. So it is called efficient frontier, or Markowitz efficient frontier. It's called Markowitz efficient frontier. The investors are rational and reasonable. So investors, the investors who want to invest in this structure, they will invest on this efficient frontier. They'll invest along this Markowitz efficient frontier. We call these investors, Markowitz efficient investor. Okay, so based on this step, our final outcome is the Markowitz efficient frontier, which includes the group of most dominant investment option. Right? So that's the outcome for the first step. Second, now when we come up with the Markowitz efficient frontier, now we have to incorporate the next idea is the investors' utility curves. I think you learned this one in economics class, right? So I mean, I think in your economics class, probably the utility curve for two goods, combination of two goods, like I think popular the example would be Coke and pizza, right? Coke and pizza. All right, Coke. I mean, you have more Coke, you get more satisfaction, right? Yeah, more pizza, you get the satisfaction, but within the reasonable boundary. So the definition of a good is the more you spend, the higher your satisfaction will be. That is the definition of a good. The more of a good you spend, the higher satisfaction you'll get. On the other end, the bad definition of a bad is the more of a bad you spend or you consume, the lower satisfaction you get. All right. So I think you remember that the utility curve there. I mean, if we apply that idea to this risk and return. Okay, return is an example of a good because the higher return that makes you the more satisfied, right? But standard deviation is a risk. So expected return is an example of a good. But standard deviation, that's a risk. The higher risk, your satisfaction will go lower, right? Low risk, your satisfaction will go higher. So standard deviation is an example of a bad, right? So it is. The expected return is a good. So the higher, the better. But standard deviation is the risk level is lower, the better. So the direction of your increasing satisfaction is northwest. You see that? The higher expected return or lower standard deviation or risk, lower risk, this northwest direction is the direction of your increasing satisfaction. Okay, and then utility curve, that this utility curve should locate it this way. So that's from your economics class, right? Okay, let's apply this utility curve or utility curve for the standard deviation risk and return, and then combine that with the this Markov-Witt efficient frontier. Let's put this together. So this one is Markov-Witt efficient frontier, right? And then the X, investor X is utility curve should look this way. Investor Y's utility curve should look this way here. Now, I told you, Markov-Witt efficient investors, they make their investment decision along this efficient line, efficient frontier, right? Efficient frontier. So for X case, the maximum available, achievable satisfaction is U2. U3 is not achievable, is out of their range. U1 is possible, but it shows much lower satisfaction. The maximum satisfaction that this investor X will get is U2, is the tangent point, X, right? X is the maximum or optimum point for this investor. In the same way, Y is the Y star. Y is the maximum satisfaction point or optimal investment decision for investor Y. Investor Y. Okay, so we look at the two different investors, and they're the best or optimal investment decision, investment combination there. They're different, right? They're different because of the difference in their utility curve of these two investors. Now, how can you explain these two investors? Now, the utility curve of investor X is located this way, shaped this way because this investor X, is more conservative. They tend to stay with lower the risk. But Y is likely to be more aggressive investor because they're happy with the taking on a higher risk level there. So each person's optimal decision making, investment decision is here and here. If you compare X and Y, Y has higher risk and higher return. So we say Y is more aggressive investor, but X decide to stay lower risk and lower return. That is conservative, more conservative investor. All right. So we just combined this Markov-Witt efficient frontier and then utility curve, graphically or conceptually this way. But if you do graduate level, upper level, or more competitive graduation finance investment course, this one could be, everything could be not just graphically, but mathematically. They develop mathematical model and mathematical approach, right? But that is beyond our class. So I think this one is good enough. So Markov-Witt portfolio theory part 1 is the quantitative mathematical model of the return and risk of a portfolio, right? Investment portfolio. And then it successfully shows the risk diversification effect for these 3 cases graphically. Markov-Witt theory, portfolio theory 2, it shows the process of individual investors searching for their final optimal decision making based on the Markov-Witt efficient frontier and then utility curves. And then we came up with the best investment decision for investor X and investor Y. So that's the second part of the Markov-Witt efficient frontier. I mean, Markov-Witt portfolio theory, 1 and 2. All right. Capital market theory. Capital market theory is extension of Markov-Witt portfolio theory. All right. So capital market theory starts with Markov-Witt efficient frontier and, of course, Markov-Witt efficient investor. In addition to that, we introduce this theory, introduced the existence of risk-free asset in the investment analysis. Okay, so meaning Markov-Witt efficient frontier. I mean, we did that. So the investment decision. I mean, here investment portfolio will include this risky asset on Markov-Witt efficient frontier plus risk-free asset, right? This is realistic, you know that, right? We include in our investment portfolio that we include risky like stocks, and also we include the bonds, fixed income securities, and we also include like cash equivalent, money market securities, right? Money market securities, which is like similar to risk-free asset. T-bills, money market securities. T-bills is one of the money market securities. So this capital market theory extend the Markov-Witt this Markov-Witt efficient frontier, Markov-Witt portfolio theory to more realistic way. Yeah. All right. Potential risk and return and risk-return combination. So that was Markov-Witt efficient frontier. So as you see, any combination, any point on this curve is risky. It has some degree of risk, right? So it's a combination of risky assets. But as I said, we introduced the risk-free asset in the investment analysis. So risk-free asset is risk-free asset. That means zero risk. So it should be y-axis. It is located here. Risk-free rate of return there. Okay. So risk-free asset is located. We can locate that risk-free asset on the y-axis with zero standard deviation or with zero risk. Okay. So if you combine anything between these two, let's use this. If your decision is combine risk-free asset and some risky asset here, so you could combine this one here. So meaning you combine risk-free asset and one of the risky portfolio in your portfolio. So combination of this and this is on this line. On this line, that shows every combination of risk-free asset and this risky asset. So if you divide your capital 50% on risk-free asset and 50% on this risky portfolio, the midpoint is your portfolio, right? Portfolio. If you invest like 80% of your capital in this risky asset here, 20% on risk-free asset, it should locate it about 80% of here. Yeah, that should be your combined portfolio. So you can always combine this risk-free asset and risky portfolio here freely. I mean, if you want to go for lower risk, you can go this way too. Okay, so here, so we have one A, B, yeah. Let's combine, compare A and B. Let's do this one here. Right, you copy that, and then here, all right, come here. Okay, so A and B, okay, this A and B, so let's look at a little bit bigger. Now, this one is A, lower part, and this one is B. If you combine risk-free asset and A, all possible combinations should locate it here, right? 50% is located in midpoint and every possible combination. If you invest the 100% of your money in the A, it should be here, A. Right? 100% of capital is invested this risk-free asset, it should be located here. Right? Now, if you compare these two, let's compare A case and B case. Remember that simple dominant theorem. For a same risk level, higher return dominate lower return, right? So B dominate anything on this line with B dominate everything below that. So this one simply dominated. Okay. You can continue that one here. I mean, you could find, I mean, wait a second. So this one is dominated. So you could continue, and for example, like C, right? C, if there's C there, that C dominate that B. So this one is dominate. You could continue that until you hit the M. Okay, let me give you this way. Now M is here. M is here. Okay, tangent line. So any, I mean, the combination on this one, this tangent line, that include any possible combination that dominate everything. Oops. Okay, that dominate everything there. So you could continue that, and then that one is the maximum you could go, and that's why you get this one M and this extension. So let's extend this one here. This one. So this dominant, I mean, the tangent line, and this one is, that one is the group of most dominant group that dominate everything below there. So we came up with the new dominant group, which is like, you know, I would say new efficient frontier. So with the we started with the Markov efficient frontier, and we introduced risk-free asset in this investment analysis. And then if we combine this two, this one is the new dominant group of investment decisions. And that one is called capital market line there, right? Capital market line, CML. So this one dominate everything. Anything below this one is completely dominant. So with the introduction of the risk-free asset in your analysis, we got this CML. That's the most dominant group. That is called capital market line. Okay, capital market line. All right. Here, let's look at this one here. I mean, yeah, okay, all right. Okay, so here the market portfolio. I mean, this M, the most dominant, like the risky asset, it is called, by definition, is called market portfolio. So the definition of market portfolio is, it is comprehensive portfolio that include all risky asset in the market, you know, in proportion in their market value. So this one, this market portfolio is a perfect example. I mean, conceptually, theoretically, perfect example of a completely diversified portfolio, which means all unsystematic risk of each asset is completely diversified away. That's called market portfolio. All right. Now, if you look at this one here, between these two, I told you, if you invest half of your money on the risk-free asset and half on market portfolio, then your midpoint is your portfolio, right? And then 90% or 80% of your money is invested in market portfolio, or 20% in the risk-free asset, then it should locate it here about 80%. 80%. Now, the line, the combination between these two, RFR and M, is some combination of risk-free asset and market portfolio. So some portion of your money is invested in risk-free asset. Now, look at this. Risk-free asset is the government, the securities, right? T-bills, treasury bills. So if you invest your money in treasury bills, what does that mean? Is part of your money is lent to the government, because T-bills are is a good the borrowing tool for the government, right? Right. So from your perspective, you lend some money to the government if you invest your money, some part of your money in the risk-free asset. So that's why it's called lending zone. But then M, the point M is if you invest 100% of your money in this market portfolio, risky market portfolio, then you will be here. What about this? What about this? The right-hand side. Right-hand side. Right-hand side, the investment decision will be this. You invest 100% of your money, and additionally, you borrow more money. Like you borrow like 50% more money, and then invest in the market portfolio. All right. So if you invest 100% of your capital in M and borrow more to invest in M, that is about right-hand side. Now, in this case, you borrow more money and then invest that your capital and borrowed capital, the total on the market portfolio. That's the case, right? That's why it's called borrowing zone. Okay. Do you remember in chapter 3, we did margin trading, right? Margin trading. So you invest 100% of your money, and then you borrow some money from your broker, and then invest the whole thing, 150% on the stock. Margin trading is a similar concept, right? Similar concept. So that's why it's called borrowing and lending. Lending, you lend some of your money to government by investing treasury bills. All right, as I said, the capital market theory, capital allocation line, capital market theory that create the capital market line here. Okay, now let's talk about slope of a capital allocation line. So you capital allocation line the risk-free asset NA or risk-free asset NB, right? So that's the example, but these two A's and B, A and B, this one is like dominated by this the capital market line. The slope of the capital allocation line is expected y divided x, right? That's the slope. Why change? Why change is expected return of your portfolio minus the risk-free rate minus divided by standard deviation. So expected return minus risk-free rate of return divided by this standard deviation. That is the slope of capital allocation line of anything. If you do that, if you apply that one to the capital market line, is just simply the slope of capital market line is expected return of the market portfolio minus risk-free rate divided by market standard deviation, market risk. And that is the slope of capital market line. It is called Sharpe ratio. So if you continue this way, the slope is increasing, right? Steeper. So when you hit the market portfolio, the capital market line, this one is the highest slope, right? So this simple like slope, this measure it is called Sharpe ratio, right? Sharpe ratio. So Sharpe ratio shows like relative performance of the different the portfolio. That's why it is widely used as the performance measure, Sharpe ratio. Okay, so keep that in mind. And equation of the capital market line is simple. Is intercept is risk-free rate of return plus slope is slope there, right? SF times X variable, the standard deviation of any portfolio. So the expected return of any portfolio is the sum of risk-free rate of return plus slope Sharpe ratio times standard deviation. That's it, right? X-axis is this one. X-axis is this one. And this one is intercept, right? And this one is slope. All right, intercept plus slope times x-axis. This one is y-axis. That's how you derive equation. Okay, so again, risk-free rate of return, risk-free return plus slope Sharpe ratio times x variable, which is the risk. Okay. Now, let's apply this one to the actual investment decision there. All right. Investing with the capital market line. All right. Given risk-free rate is the 4% and the market return is 10% and standard deviation is 15%, market standard deviation. So market portfolio has return, 10% return, 15% risk standard deviation. The capital market line is simply risk-free rate of return is 4, and then but 10 minus 4 divided by 15, that is the slope times sigma, times sigma. Okay, sigma where I get that. Okay, let me borrow this. Oh no, let me borrow this. Sigma portfolio. Okay. Let's see. All right. Here, this one is what? Yeah. This one is 4 plus 10 minus 4 divided by 15 times sigma times, times this one. Oops. No, wait a second. This one you should do this way. And then let me put this one closer. That is the market, that's the capital market line. All right. So 4 plus, what is that, 6 divided by 5, 2 over 5. 2 over 5. 2 over 5 is 0.4. Right? 4 times sigma. Let's use that sigma. Okay. Symbol. Yeah, sigma. Let's do sigma. That is the capital market line, right? Now, let me bring in the Markovitch model, the first model. Okay? This one and this one. In this case, the capital market theory, you divide your capital into the risk-free rate of return, risk-free asset, that T-bills, and the market portfolio, right? So WM is equal to 1 minus WRF, that cost, because you divide that into market portfolio and risk-free asset, right? And if you look at this standard deviation variance of the portfolio is there. Now, this risk-free rate of return, we know that that's risk-free or riskless asset. That means sigma should be 0. This one should be 0, and this one should be 0. So it came down to WM times squared and the WM. So standard deviation of portfolio is WM times W and sigma M. Simple, right? Suppose, so this is capital market theory version of the standard deviation there. Suppose your risk tolerance is 9%. Then what does that mean? Your risk, you have to use this one. I mean, you could use this one. 9%, I mean, here, 9% is equal to WM times 15. Sigma M is 15, right? Sigma M is 15. Right? Then, what does it show? WM is equal to what? 9 divided by 15. Okay, 9 divided by 15. So what do you have? Oh, this one should be. Okay. Is 9 divided by 15 is what? 0.6, right? 60%. Then WRF should be 1 minus WM, 1 minus WM. So what do you have? 0.4. Is that right? No. This one is 1 minus this one. Yeah, okay. 33, 35. Yeah, right. What does that mean there? If your risk tolerance level is 9%, if you look at the market portfolio is 15% standard deviation and 10% the return. So if your the risk tolerance level is 9%, which is quite lower than the market risk level, if you go lower risk, then you should be satisfied with lower return, right? So quite conservative. Yeah. So to come up with this 9% risk tolerance level, you invest 60% of your capital on the market portfolio, risky portfolio, and 40% of your capital on risk-free asset. Then your risk, the tolerance level is 9%. All right, so we got 9% there. Then let's calculate the return. Let's calculate return. So it's the risk moment. Yeah, 4%. 4% plus 10% minus 4% divided by 15% times, what is that? Portfolio, 9%. All right. I mean, the risk tolerance is 9, and then I use the capital market line, and then this is your expected return. Wait a second. Expected return. All right, here. Your expected return is 7.6% based on your risk tolerance level. So you go conservative, then your return will be lower than the market portfolio there. You follow me? Okay. Another example. Investing with the capital market line. Suppose you have a riskless security at 4%, market portfolio with a return 9% and standard deviation of 10%. How should you go about investing your money so that your investment will have a risk level of 15%? This one is quite example, very interesting. Now here, do you remember that? I mean, let's use this one here. Let's bring that in here. In here. So that means is 15% is equal to, 50% is equal to WM times sigma M is return risk 10, right? It's 10. That means, I mean, your risk tolerance is 15%. 15% is equal to WM times 10. So what does that mean? WM is equal to 15 divided by 10. What do you have? 1.5, 1.5. You see that? Then WRF, RF should be minus 0.5 because sum of these two should be equal to 1. What does that mean? What does that mean? So this is exactly the case of borrowing zone. So you invest 100% of your capital on market portfolio, risky portfolio, and then you borrow 50% more and then invest in the market portfolio. All right. So your RF is minus. Yeah. That is the answer for this one. And your return will be then, if you look at the if you look at the capital market line, 4% plus 9 minus 4 divided by 10 times your standard deviation is 15. So calculate that. You calculate this one here, 4 plus 5 divided by 10 times 15, okay? You have 11.5%. Look at this. So your risk level is much higher than, quite higher than the market portfolio. So your return should be higher than that market portfolio, 9%. Right? So your risk level is 15 versus 10% market, and your return should be 11.5% versus 9%. The market portfolio, right? So WX is this one is here. You borrow 50% and invest 150% of your capital in the market portfolio. Okay, so we saw this one. This is why it's called borrowing, and we saw a similar concept in margin trading. Borrowing from your brokers, and you 50% borrow from your broker, and you invest 150% in the stock. That's it. Okay, that is the two examples how to utilize the capital market line and capital market theory in your investing with capital market line. All right. Any question? is not, it's the mathematical quantitative, and some part is challenging, but I think if you follow that carefully, it all makes sense. It's not that complicated, not that difficult. It will make sense to you. Okay? All right. Let me stop it.